selling options may be one of the best ways to generate passive income. However, there's just one problem. It's not exactly the easiest skill to learn. That's why in this video, I'll be showing you everything almost you need to know about selling options. This includes the basics of selling options, a step-by-step guide on how to do it, how to maximize your potential for profit, and more importantly, how to manage your risk so that you don't burn your backside while selling options. Sounds good? But before we start, do join my Telegram channel to discuss stocks, personal finance, and even options. Okay, let's start with the basics first. There are two kinds of options that you can trade, a call and a put. A call option gives the option buyer the right but not the obligation to buy the stock at the strike price on or before the expiration date. Meanwhile, a put option gives the option buyer the right but not the obligation to sell the stock at the strike price on or before the expiration date. Here's a simple example to visualize this. Let's say you have a stock that's currently trading at $100. If you have a call at the strike price of $80, this allows you to buy the stock at $80. Or if you have a put at a strike price of $120, this allows you to sell the stock at $120. Got it? Call lets you buy, put lets you sell. Now, here's where it gets interesting. Besides buying an option, you can also sell option. So when you sell a call, this gives the option buyer the obligation to sell the stock at a given strike price on or before the expiration date. And when you sell a put, this gives the option seller the obligation to buy the stock at a given strike price on or before the expiration date. So using back the previous example, if you sold a call at the strike price of $80, when the option buyer exercises his call option, you will have to sell your stock at $80. On the flip side, if you have a put option at a strike price of $120, when the option buyer exercises his put option, you would have to buy the stock at $120. Next, when you are buying options, you have to pay money to buy, or the official term is pay a premium to buy the options. And where does these premiums go? It goes to the person that is selling the options. The goal for both the buyer and the seller is totally different. As a buyer, I want the option to go in the money, because the further in the money an option is, the more money that I will profit from the option. And as a seller, I want the option to expire out of the money. That's because if the option expires out of the money, I won't have to buy or sell the stock, while at the same time, I get to collect a free premium. But the question is it better to be an option buyer or an option seller? The answer is option seller. Here's why. As an option seller, you have a few things working in your favor. One, you get to collect a premium. This will help you to lower your break-even price. So let's say if the stock is at $100 and you sell a put option at $95 and you collected a premium of $2. This means the stock has to drop below $93 for you to start losing money. 2. Time is on your side. That's because all options have an expiration date, and as time passes, the option's value will slowly decay until it reaches 0. But what affects the option price?
How come it's sometimes high, other times it is low?
Let's use an example. Let's say we have a call option that has a strike price of $10 and it costs $3 to buy the option, and we have a stock at $12. If we exercise the option now, we'll be able to buy the stock at $10 and sell it at $12, thereby profiting $2. This means the option has an intrinsic value of $2. This intrinsic value is the final value of the option at expiration, or how much it is intrinsically worth. So then, where did the extra $1 came from? That is the extrinsic value. Extrinsic value is affected by two things. The first one is time. The more time you have, the higher the chance that the stock will go deeper in the money. Here, I have two options that have a strike price of $185. The option on the left expires in a week and it has a premium of 27 cents. Whereas the option on the right expires in a month. You can see that the premium is a lot higher at $1.72. This is also the reason why it is better to sell options that are further out in time, because the further out you go, the more extrinsic value that you get to earn. Besides that, extrinsic value is also affected by the implied volatility. Implied volatility is the market's forecast of a likely movement in the stock price. Here's an example. If the stock is trading at $100 per share and has an IV of 20%, this means the projected price movement for the stock is between $80 to $120 over the course of a year. According to the chart, there's a 68.2% chance that this will happen. And if we extend this further, there's a 95.4% chance that the stock will move between these points. So those are the basic stuff that you need to know when selling options.
Okay, sounds good. Let's start selling options now.
Hold up, before you even start, there's one more thing that you need to know. Whenever you sell options, you need to have collateral. Because remember, when you sell an option, you have the obligation to either buy or sell the stock at the strike price. So when you are selling a call, you need to have 100 stocks as collateral so that if the option buyer exercises his call, you are able to sell your stocks. And if you are selling a put, you need to have enough cash to buy 100 stocks so that if the option buyer exercises his put, you are able to buy the stocks. This is super important because if you don't have collateral, that's called selling naked options. Bad things will happen when you do that. And by that, I mean you can incur a huge loss, like this guy who lost over 650k selling naked options. So don't go naked, yeah? Naked is bad. Now, here's the plan to sell options. First, you sell the option. Second, you collect the premium. This premium is now yours. You want to use it to buy more shares? Can. You want to use it to get a Thai massage? Can also. Third, you wait for time to pass and pray that the stock doesn't go in the money. And fourth, if things go your way, you can just let the option expire worthless, or you can buy back the option to lock in your gains or losses. And finally, just repeat the whole process again to generate a consistent income. Sounds easy? Let's try this out. Here, I'm using interactive brokers, but the steps will be similar on other platforms. I'll be selling a put option on the famous fruit company, Apple. To do that, I can just click on the options button to open up the options chain. The first thing that I want to do is choose an option that is further out in time so that there's more extrinsic value. Let's go for December 29, which is about 31 days from now. I want to sell a put, so let's go for the $185 put option on the right. Here's a nice trick. If you mouse over the ask price, it will show buy. And if you mouse over the bid price, it will show sell. I want to sell the option, so let's click on the bid price. Let's analyze this. If you decide to sell at the ask price of $1.56, you get to collect a premium of $156. Because remember, each option contract represents 100 shares. This will be your max profit. As for the max loss, RBKS number is not updated. Instead, it should be $18,344 instead. That's because if you bought 100 shares at $185 and the stock goes all the way to zero, you will lose $18,500, right? But because you also collected a premium of $156, this will help to offset some of your losses, making it $18,344. Then if you scroll all the way down, you will see that this contract has a probability of profit of 80%. As mentioned earlier, when you are selling options, you are hoping that the option expires out of the money. So in order to increase your probability of success, what you can do is go so far out of the money until your probability of success is almost 100%. But the problem with that is you will only collect a very tiny amount of premium, which in this case, it is $2. Might as well don't take. So the trick is to sell far out of the money, but at the same time, not too far out until you get nothing. That's why some people recommend selling options with a 30 delta. And that is also what I've done. The option that I've chosen is close to 30 delta, which gives about 80% probability of profit. To place an order, click on the order button at the top right. You can then turn on price management algo, which is just something that IBKR has to protect you from accidentally placing a limit price that is too far from the current price. Next, for limit price, what people usually do is use a mid price between the ask price and the bid price. And if it doesn't get filled, they will slowly move the price towards the bid price. Once you are done, click preview. The most important thing is to check that you are selling an option, not buying, yeah. The last thing you want to do is go buy an option like a dumb and lose money, yeah. So in this case, the position change should be -1 or minus whatever amount that you are selling. If the order goes through, I'll be collecting $159, and the commission that I'm paying is somewhere between 61 cents to $1.54. Once you're ready, just click Transmit Order and wait for it to get filled. To check your order, you can head over to Trade, Orders and Trades. If the order is filled, it will say filled. And here, you can see that I collected $167 in premium and I paid a commission of $1.04. After you have sold an option, it will now show you that you have a negative position on the option. Don't worry, that's perfectly normal, yeah? When you buy, it is +1, and when you sell, it is -1. Also, if you check the unrealized profit and loss, you will see that there's a change in value. In this case, it shows $6.47.
What does this mean?
I saw many people get confused about this, so let me explain. Scenario 1, if I don't do anything, whatever happens to this option doesn't affect me. So the $167 premium that I've collected stays with me. Scenario 2, if I decide to buy back the option and close the contract, I will now have to pay its current market value, or $155.89 to buy back the option, which means that my profit would be $6.47.
But why would you buy back the option? Wouldn't it be better to just let it expire and you get to keep 100% of the money?
Here's why. So let's say you sold an option that has an expiration of 1 month, but by next week, the option has dropped to 50% of its value. Instead of waiting 3 more weeks to earn the remaining 50%, it is much more efficient to close the option and sell a new one to earn another round of premium. And also, as long as the contract is still open, you have an obligation to buy or sell the stock. So by closing the option early, you are locking in your profits and will no longer have the obligation to buy or sell the stock. So with that in mind, let's see how we can close an option position. If you are using the web, just look for the contract in your portfolio, click on the 3 dots on the right, then click close. Then everything is the same here. You enter in the limit price, click preview and submit your order. I will also show you how to do it on the mobile just in case you need it. Same thing, tap on the contract in your portfolio, then at the bottom, do you see this related position? Pull it up and you will find the close position button. Then just proceed to close the option as per normal. Besides closing an option, there's one more thing you can do, and that is roll option. Rolling an option is just a fancy way of saying buying back to close an option, then selling another new option. It's just a shortcut way of doing things. There's no way to roll an option in the web platform, so I will just show you how to do that in the mobile app. To roll an option, tap on More on the bottom right, Option Exercise and roll over. Look for the option that you want to roll, then tap Roll. At the bottom, you will see that it is already going to buy back the option. So what you need to do now is look for a new option to sell. So in my case, I will go for the 30 days expiration 30 delta option. If I check the option legs, I will see that there are 2 orders, which will add up to the final ask, meet, and bid prices. After that, everything is the same again. Just choose your order type, enter your limit price, then select to buy, and you are done. Finally, here are some tips on how to maximize your profits while reducing your risk. First, sell options that are further out in time. The recommended number of days are around 30 to 45 days to expiry. That's because by having more time, you get to collect more premiums. Second, sell options at around 10 to 30 delta. This will give you a higher probability of success while at the same time give you a reasonable premium for the risk that you are taking. Third, always try to take profit at 50%. This will ensure that you are realizing your gains efficiently without having to wait till expiration to realize your profits. Fourth, spread out your options. What I mean by that is, let's say you have 10k. You don't want to use up all your collateral on just one option. Instead, what you can do is spread out that 10k on different options over a few weeks. So that every week, as the stock goes up or down, you will get to keep selling options at, let's say, 30 delta, but at different strike prices. When you do that long enough, over time, you will see your probability of success moving closer and closer to 70%. Here's one more bonus tip. Make use of technical indicators. But if you are like me, you will suck at reading stock prices. But don't worry, because IBKR has recently added a new feature that makes this easier. To find it on the web platform, click on Research, Discover, Technical Insights, then look for the stock that you want to analyze. Here, you will find a quick chart analysis for the short term, intermediate term, and long term. For example, for the short term, the relative strength index shows that we might see a short-term bearish movement soon. But in the intermediate term, there's a bullish movement. Also, if you scroll down, you will see different support and resistance for the stock depending on which period that you are in. If you tap on them and tap on the bell icon, you'll be able to add an alert to notify you via email when the stock reaches the price. So that's nice. So that was a quick introduction on how to sell options. What will also help is that you are keeping a record of all your options trades so that you will know what works, what doesn't work, and slowly make adjustments along the way. Like if 30 delta doesn't work for you, then you can try going lower to like 15 delta to improve your probability of success. I have a free options spreadsheet if you need a way of keeping a record. The whole idea of selling options isn't to get rich quick. It won't happen here, yeah. Instead, it is to make small but consistent gains, which over time would add up. Anyway, that's all for this video. Hopefully, you found this useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.